The link to the original documents can be found in the description or comments below. This video contains 5 separate write-ups on the company Cisco systems ranging from 2011 to 2017. Company name, Cisco Systems. Ticker, CSCO. Write-up 1. Long thesis. Date posted, August 14, 2017. Description. Cisco Systems Incorporated (CSCO) is a megacap technology company that develops, manufactures, and sells networking and communications hardware, software and services to the global IT industry. Over the years, Cisco has evolved into a true tech Goliath, with an enormous installed base that DB estimates at over $250 billion, comprising 840,000 customers, which affords it all the advantages of being an integrated tech platform and one-stop shop, along with tremendous global brand awareness and economies of scale. Yet, today, due to various recent industry and competitive trends, and uncertainty over technological innovation within the company, Cisco trades at a very inexpensive EV yield of 10.1%. We think the market's concerns are overdone. Cisco is still the dominant player in the enterprise, with a stable business generating lots of cash, and there are reasonable growth prospects for the company as it shifts its business model away from its legacy hardware business and towards new higher growth areas within software and services, a change that is occurring more quickly than the market thinks. Bear case. The bear case against Cisco, however, is compelling. In the bear view, Cisco is an aging behemoth, losing market share in its core switches and routers markets to a host of smaller, nimbler competitors, who are leveraging disruptive new cloud-based networking software technologies to attack Cisco's old-fashioned hardware franchise. Cisco's market share has declined across multiple categories in recent years. Indeed, in the current fiscal year, each of Cisco's top 4 product categories, which make up over 80% of its product revenues, are shrinking at single-digit rates. Ouch! The bears argue that in today's increasingly software and cloud-based world, Cisco's core business of switches, routers and hardware are a little like toasters. And if you are making toasters, there's not much of a technology edge available. Ultimately, competition becomes a manufacturing efficiency game in which others enter the market and compete margins and returns on investment down to unattractive rates. We think this is the wrong perspective for understanding Cisco. Before getting into the business segments, we would observe that the scale and breadth of Cisco's business allow for much more analysis than offered here. Each business segment is multi-billion-dollar business on its own, and the company is changing so quickly several different analytical frameworks, old and new, can be used to understand it. The company is like an onion, there is layer after layer of detail for those who want to look deeper. But providing exhaustive and granular detail is not our purpose. We think that understanding a few of the big revenue pieces and dynamics of how the company's product offering is changing will give a sense for why it's a value stock today, but nevertheless is still a franchise worth owning at this price. Business segments. Switching. Cisco's largest product segment, comprising 40% of product revenues, is network switches, a market in which it is the global leader, albeit a faltering one. Businesses use switches to connect devices to each other via a network, such as a local area network, LAN. They might connect PCs, printers, servers, and so forth. Switches essentially allow devices to communicate in an efficient way within a network. As bandwidth use has exploded in recent years due to new voice, data and other requirements, next-generation 10 GB and 40 GB high-performance switches have been essential to efforts within enterprises to maintain network performance. According to IDC, the worldwide switch market has grown steadily over the past few years, including at a modest 3%-4% rate in 2016 and early 2017, driven by strong international growth and customer movement to higher speed, e.g. 10 GB, switches. Despite these reasonably favorable dynamics, Cisco has been unable to take advantage, with switch revenues shrinking along with market share, which was at 56% in late 2016, down from 59% a year earlier, and from 75% in 2011. We'll come back in a moment to this market share erosion. NGN routing. Cisco's second largest product segment is routers, which make up 22% of its product revenues. Routers allow networks themselves to communicate with one another and direct traffic among them. Routers can take raw information from a broadband broadband signal, example from a modem, and interpret it for different receivers, such as a computer or a phone, which might be on a subnetwork. Crucially, routers can be used to enhance the effectiveness of firewalls and network security. The global market for routers has also grown, but more modestly than that for switches over the past few years, including 1% during 2016. Cisco is the market leader for routers with a share of 42% at the end of 2016, down from 45% a year earlier, and down from greater than 60% in 2011. The company, while still a dominant participant in routers, is losing market share in this segment as well. Software-defined networking. What accounts for Cisco's shrinking share of a growing market? Although switches and routers are Cisco's bread and butter, in today's tech world, such hardware is increasingly viewed as a generic off-the-shelf, white-box commodity that can use merchant silicon and run open-source software. Today's networks are defined not by hardware, but by the software layer offered as a software-as-a-service (SaaS) product that defines the price/performance characteristics of the network. Arista Networks is a good example of the threat to Cisco's core business from software-driven, cloud networking competitors. Arista makes switches and routers that use silicon from Broadcom, but more important, offers proprietary containerized software to serve the networking needs of large cloud businesses like Facebook and Google. Cisco recognizes that the world is changing, and is responding in kind by moving its business towards a service and software model delivered in the cloud. Collaboration. Collaboration, which is Cisco's third largest product segment, making up 11-12% of Cisco's product revenues, offers a microcosm of this trend. Collaboration allows the integration of voice, video, example, video conferencing, and data, example, web sharing, across applications such as blogs, chat, shared workspaces, etc., and across multiple devices, such as phones, PCs, tablets, etc. Collaboration revenues are shrinking modestly today, but within the segment there is a shift from revenues from sales of on-premise, endpoint hardware, such as phones, to recurring revenues from application software sales, in this case conferencing software. An example of a SaaS application hosted and delivered through the cloud is Cisco's SparkBoard, a collaboration and meeting room software solution. In the most recent quarter, 700 customers adopted this new solution. In fiscal 2017, approximately 58% of Cisco's application revenues were software-based, and the company anticipates its application business will grow at high single-digit rates, as the company continues pushing into software and the cloud. This type of shift to software has various implications for near-term and longer-term revenues across Cisco's business segments. Shift to software subscriptions, growth in deferred revenues. Traditionally, when Cisco has made hardware sales, such as within its core markets for switches and routers, it has recognized revenues when a box left the warehouse, and the customer had a perpetual license for software associated with the device. Under Cisco's transition to software as a service, SaaS, and cloud delivery sales model, customers will pay a yearly licensing/subscription fee for software that is continually updated. While upfront revenues are smaller than under the previous model, under the new model they are recurring and more predictable as deferred revenues are recognized over time. Cisco anticipates that over the next 3 years, deferred revenues from software products sold as a subscription will grow at a 5% to 10% CAGR. Moving to a SaaS model may cause a near-term revenue decline, as larger upfront revenues are replaced by smaller per-year ongoing subscriptions, but over time this effect will be mitigated as the volume of subscriptions builds. In fiscal 2017, approximately 10% of product revenues were recurring, while in 2020 the company expects approximately 20% of product revenues will be recurring. Cisco expects software to represent 30% of revenues by FY 2020, up from 22% in FY 2017. That is a significant change. Security. Consider security, which represents only 5% of Cisco's product revenues, but which is growing at near double-digit rates. Several products within security are driving this growth, including unified threat management, with growth of approximately 50%, and advanced threat and web security, both of which are growing at over 30%. Cisco's strength in networking position it ideally to become more successful in security, where it can offer a standalone, cloud-based software solution. In fiscal 2017, approximately 47% of security revenues are represented by software sales, note that in the most recent quarter deferred revenue within security grew 39%. Service revenues. Cisco is also moving its business towards service revenues, which increased this fiscal year across all segments, and are growing at single-digit rates, today making up approximately 25% of Cisco's revenues. Advanced services account for most of this growth, including solution support, 11% revenue growth over past 2 years, and technology advisory services, with 4% revenue growth over past 2 years. Aggregate service revenues are growing at an approximately 4 to 5% rate, which may increase due to additional focus on high-growth security, cloud, and automation areas. Service revenue, consistent with the software subscription models it supports, is also trending toward recurring revenues. Today, 30% of product plus service revenues are recurring, and Cisco anticipates that figure will go to 37% by 2020. Wireless and data center. Wireless and data center combine to make up approximately 9% and 7%, respectively, of Cisco's product revenues. This fiscal year, wireless is growing modestly, while data center has shrunk. The reason we combine wireless and data center here is because Cisco's core business of switches and routers combine with these business lines to form Cisco's infrastructure platforms. This is where we may see the most pronounced shift to software over the next few years. As the largest networking company in the world, Cisco is poised to benefit from the growth of the Internet of Things, IoT, and connected devices worldwide. IDC projects that the IoT endpoints will grow from 14.9 billion in 2016 to 82 billion in 2025. Infrastructure platforms. Software revenues today make up only 14% of revenues in infrastructure platforms, but that is changing rapidly. Cisco anticipates that deferred revenues for infrastructure platforms will grow through 2020 at 20+% CAGRs. There are a few key drivers. Cisco One Software is a new portfolio of software products that spans the technology categories of data center and cloud, WAN, access, and security. Cisco Enterprise Agreement spans infrastructure, data center, security, and collaboration portfolios. Digital network architecture is focused on centralized network management in environments characterized by trends in mobile, IoT, and the cloud. M&A activity accelerates the move to software. One mechanism Cisco employs to accelerate its push into software and services, and maintain their pace of innovation, is through a steady diet of acquisitions. Indeed, 80% of the company's acquisitions over the past 4 years were of software businesses, and these have been successful. For instance, 2 of Cisco's higher-profile acquisitions in recent years, Meraki and SourceFire, have both earned double-digit returns. More recent highlights of this effort include a variety of firms. Last month, Cisco announced the purchase of Observable Networks to complement its organic growth in security. A few months ago, Cisco spent $610 million to acquire SD-WAN competitor Viptela. In January, Cisco announced it would purchase software data platform AppDynamics for $3.7 billion just before AppDynamics was to go public. Cisco maintains a 160-member dedicated integration staff, and prides itself on its ability to maintain 80% of acquired talent. This M&A activity provides the company access to new markets and accelerates the move towards software and services. Brand. Cisco is a top global networking brand with strong name and brand recognition. It has a reliable product set, stable market position, and well-established customer support and service. Whatever you may think about the prospects for Cisco's legacy hardware business, it continues to be a market leader in networking. The brand, and the company's technology know-how and experience, contribute to its franchise value, enabling the company to earn high returns on capital, generate cash flow, and maintain stable margins. Strong returns on assets and capital. Cisco has a remarkably consistent ability to generate returns on its assets. This is reflected in its long-run, 8 years, geometric average return on assets of 8.7%, which in our universe of tradable stocks puts it in the 73rd percentile. Not bad for a $160 billion company. Cisco's long-run ability to generate returns on capital is also impressive. It offers a compound return on capital of 11.7% over the past 8 years, placing it in the 68th percentile of our universe. Cumulative free cash flow to assets. Cisco has been a cash flow machine for its owners. Over the past 8 years it has generated $85 billion in free cash flow, representing 71% of the assets on its balance sheet. When scaled by assets, this places the company in the 80th percentile of our investable universe. High and stable margins. Cisco is able to maintain its margins through a variety of means, including accretive acquisitions, benefits of scale, pricing power across its product portfolio, and cost savings driven by the move to software and services. Below are Cisco's gross margins for each of the last 8 years. TTM 63.1%. 2016 62%. 2015 60.4%. 2014 60.1%. 2013 60.9%. 2012 61.4%. 2011 61.9%. 2010 64.6%. These are high and extremely stable margins, by any standard. We have an internal methodology that combines how high margins are with their stability, using a Sharpe ratio approach to compute overall margin strength/stability. We find Cisco is in the 87th percentile of all tradable companies by our measure. Financial strength. The company has had strong free cash flow over the past 12 months, and has grown free cash flow in 5 of the past 7 years. In addition, free cash flow exceeded net income, which indicates that company is not using accruals, which would be an accounting red flag for us. For the trailing 12-month period, Cisco generated 8.8% return on assets and an 11.6% return on capital. Both figures are nearly identical to the long-run geometric averages cited above. The company has also paid down debt over the past 12 months. The company has grown its margins in each of past 3 years. The Today company holds approximately $68 billion in cash, with almost all of that total held overseas. The Trump administration has proposed a one-time 10% tax on all repatriated cash, so in the event that were to occur, Cisco could see significant value creation. Return of capital. Over the past year, Cisco has been a net repurchaser of stock. This is in keeping with a long-term trend. Over the past 10 years, Cisco has devoted approximately half of its free cash flow to share repurchases. Since 2002, Cisco's shareholder-friendly use of free cash flow has enabled it to repurchase approximately 32% of its shares. Cisco has also grown its dividend at a 30% CAGR since 2011. The below figures represent the percentage of free cash flow returned to shareholders through dividends and repurchases over the past few years. FY14 120% of FCF. FY15 73% of FCF. FY16 70% of FCF. FY17 70% of FCF. Conclusion. It is said that turning an aircraft carrier is a gradual process. Likewise within Cisco, change will not occur overnight, but from a multi-year perspective, the company is on the cusp of a significant shift in its business model. Cisco anticipates growing its software business at 12% to 15% CAGRs through 2020. While Cisco is today primarily a hardware company, within the next 3 years it will become a software company, as software and service revenues will for the first time exceed those for hardware. The revenue mix will reflect this change, going from today's predominantly perpetual software licenses to predominantly subscriptions by 2020. These profound changes are masked by the company's declining legacy business, leading to a short-sightedness by the market, which is focused only on the decline in Cisco's core switch and router markets. For this reason, the company is on sale today, with an EV yield of 10.1%, cheaper than greater than 90% of stocks we consider for investment. We believe Cisco represents good value at this price. I do not hold a position with the issuer such as employment, directorship, or consultancy. I and/or others I advise hold a material investment in the issuer's securities. Catalyst. Shift to software and services. Growth in recurring revenues. Growth of applications and security. Continued return of FCF to shareholders. Write-up 2. Long thesis. Date posted, January 27, 2014.
Description.
Over the past several years, the bear case on Cisco has remained largely the same. Cisco's legendary 60 to 70% gross margins are poised to decline given increased competition due to the emergence of new emerging switching and networking technologies, as well as the rapid growth of the cloud. This threat has intensified, if anything, over the past few years as technology leaders such as Google and Facebook have embraced software-defined networking versus Cisco's traditional networking technology, and highly visible companies such as Netflix have largely outsourced their IT to the cloud. Even on GAAP earnings adjusted for Cisco's $35 billion in cash taxed at 35%, Cisco now trades at 9.1x F13e earnings and 10.2x F14e earnings, versus the market at over 15x. At this point, we think that Cisco's stock price overly discounts the risks to the business and ignores potential upside from recent new product introductions in the core business and ongoing growth in new product areas. We believe there is a decent possibility that the combination of new product introductions in Cisco's core networking and switching businesses and ongoing success in several growth areas of the business will lead Cisco to at least maintain, if not modestly grow earnings over the next several years. Should our base case of flat to 5 to 7% annual EPS growth play out, we see the potential for 30 to 50% multiple expansion from 9-10x, leading to 50% plus potential upside over the next 12 to 24 months.
Cisco's 2013 revenue breakdown. Networking 47%. Routing 17%. Switching 30%. New products 30%. Service provider video 10%. Collaboration 8%. Security 3%. Wireless 4%. Data center 4%. Services 22%. Source: Cisco. For reference, a core component of the bear thesis on Cisco surrounds the potential for Cisco to lose its enterprise networking business due to outsourcing to the cloud, which will be provided by service providers.
Note that roughly 50% of Cisco's revenues, as well as perhaps 2/3 of the service revenues, 15% of total revenues, derive directly from the total legacy networking business, though a Credit Suisse analysis of Infonetics data estimates that approximate 33% of Cisco's total revenue derives from enterprise networking products, while approximate 14% of total revenues derive from networking products sold to service providers. Assuming an additional 1/3 of Cisco's services revenues derive from enterprise networking, for 7% of total revenues, enterprise networking could potentially comprise approximate 40% of Cisco's total revenues. And given relatively higher margins of 60 to 70% estimated in the networking business versus 50% in new products, Cisco's enterprise networking business potentially comprises 50% of Cisco's total gross margin dollars. The fact that such a large percentage of Cisco's earnings derive from the core enterprise networking business adds weight to the bear thesis of the decline of on-site enterprise IT on the stock. We think that Cisco can largely maintain this revenue stream through sales of its legacy and new products to both enterprises and service providers.
Key components of buy thesis. First, the stock is very cheap. Cisco is trading at 9x F13 GAAP EPS ex tax ADJ cash, and 10x F14 EPS ex tax ADJ cash. From a valuation perspective, not taking into account the cash, Cisco is trading at a near 5-year low on trailing GAAP EPS, 11.5x versus an average of 15.7x, and an absolute low from a relative perspective versus the S&P 500, 0.74x versus an average of 1.14. Also, the FCF yield is 10% and it currently pays a 3.1% dividend.
This valuation cushion would allow CSCO's earnings to decline 30% plus and have the stock still be reasonable relative to the market.
What are the chances that CSCO's earnings experience such a steep decline in the near future? Very low.
Even the bears anticipate that Cisco holds or only slightly grows non-GAAP earnings over the next several years as volume growth helps to offset their assumed margin declines given the continued robust demand environment for networking equipment. For example, on a non-GAAP basis, excluding stock options, as these are the headline numbers that many investors follow, the street anticipates that earnings are anticipated to decline 2% in 2014 followed by increasing only 5% in 2015. And let's say that even the bears are too optimistic and earnings decline beyond 2014.
The stock should still work unless earnings declines become truly secular and fall 30% plus from 2013 levels without a valuation offset at some point. A long-term decline in the stock price is certainly feasible given the potential for kitchen sinking valuations in tech, but at some point valuation should provide some protection. Also, Cisco has several levers that suggest that the company is more likely to grow EPS in the future than to experience EPS declines. Second, the bar for 2014 has been set very low. In the recently reported 1Q14 quarter, October 31st end, Cisco guided to an 8 to 10% year-over-year decline in 2Q14 sales, and 2Q14 non-GAAP EPS of 46 cents, 10% below street expectations. It further guided to non-GAAP F14 EPS of $2, minus 1% year-over-year, versus the street at $2.10. While the bears would point to this significant revenue guidance miss as a sign of worse performance to come, the two primary sources of the miss, a 20% decline in emerging markets, perhaps 10 to 15% of total revenues, and the federal shutdown, perhaps one-third of the total miss, and product transition issues in switching and routing ahead of new product rollouts, likely another one-third, are likely to stabilize/improve over time. A 20% decline in the set-top box business, perhaps 10 to 20% of the revenue miss, is likely to continue but should have a minimal impact on earnings given the low single-digit margins in this business. And the weakness in low-end edge routing due to competition from Juniper and Alcatel is worth noting, but is too small to materially impact profits should it continue longer term. Overall, stabilization of the business at this new lower level is likely to drive 10% to 20% improvement in valuation as investors gain confidence that 2014 is the bottom. In addition, if investors begin to acknowledge the potential for earnings improvement from the successful rollout of new products, Cisco could experience 30% plus valuation improvement over the coming year. Further, the Street has already brought down its own expectations for CSCO's revenue growth over the next 3 years to 3 to 5% from CSCO's 5 to 7% stated at its 2012 Analyst Day. This should help to support the stock should Cisco's revenues take several quarters to turn around. Third, this year Cisco has the potential to negate the bear case that its margins are poised to decline. The fundamental bear case is that CSCO's gross margins are just too high at 61% and must normalize to perhaps 30% to 40% at some point, given those margin levels in other tech hardware businesses such as servers and storage. Adding further credence to this bear case is the emergence of software-defined networking (SDN), which allows the customer to pair white-box networking equipment with open-source software to save 75% on hardware costs versus a Cisco solution, exposing roughly 45% of Cisco's business to potential significant disruption. Here are some thoughts on the long-term bear case. First, SDN is in very early stages and will take a minimum of 2 to 3 years to become commercial enough for most customers to consider it. This suggests that any revenue loss from this business would be very gradual, and allow Cisco and the other networking vendors time to potentially catch up and offer competitive solutions. In addition, as of August 2013, IT decision-makers had mixed views on whether SDN would lead their total networking spend to decline. A full 36% anticipated that spending would increase, and 21% anticipated that spending would not change, per a Credit Suisse networking survey. Second, and importantly, in November Cisco launched with a new series of products, Application-Centric Infrastructure (ACI) from its spin-in, ICIM, which proposed to offer a significantly more cost-effective and technologically advanced networking solution to customers than whitebox SDN. Given the buy-in that Cisco has already received from key partners such as F5, Embrain, Symantec, Citrix, Red Hat, and from initial customers including Microsoft's Azure Cloud and the second-largest cloud provider in Europe, the value proposition appears to be credible. Note that the new ACI technology costs customers more and is more profitable to Cisco than Cisco's current solution, suggesting that it could lead to earnings growth for Cisco rather than earnings declines. So why would customers buy this more expensive solution? Because it could save customers 75% in total costs versus whitebox SDN solutions and also provide savings versus Cisco's current solutions while providing improved functionality. How is this possible? First, over 75% of IT budgets are devoted to operating expenses, and ACI significantly reduces the need for IT staff through automation of network optimization.
The conversation around SDN has been too focused on lower cost equipment given the need for increased operating expenses to manage these white box systems and the ultimate need for better performance. Importantly, ACI provides this increased flexibility and programmability needed to manage more dynamic networks, and also incorporates key application control and virtualization functionality further up in the stack, thereby incorporating functionality previously offered by other vendors. Based on customer comments, the products provide superior functionality to any product available on the market today.
What if ACI doesn't live up to its promise? Cisco still has several years to improve this and other solutions before SDN can present a meaningful threat.
And given Cisco's #1 rating with IT leaders for its technical roadmap, price/performance, management quality, maintenance and support, distribution, Salesforce quality, and cloud strategy, as well as its cadre of Cisco certified network administrators working at customer sites, Cisco will be much more difficult to displace than the bears think. Separately, Cisco recently announced 2 key new routing products, NCS, Network Control Systems, and CRSX, Carrier Routing System, to replace older technologies. Customer anticipation of the availability of these new products has likely led to lower orders of the current products, leading Cisco to likely experience an acceleration in routing revenue later in the year. This should provide a further boost to earnings versus current expectations.
Fourth, Cisco can still succeed despite an enterprise IT migration to the cloud. In addition to software-defined networking, the second existential threat to Cisco is that as companies migrate IT to the cloud, Cisco will lose significant revenue due to major cloud providers choosing a white box solution over Cisco's products.
This threat to Cisco's business model is underscored by the fact that the largest enterprise cloud provider, Amazon, has largely chosen to pursue a whitebox software-defined networking solution, and other large consumer cloud service providers such as Google and Facebook have chosen an SDN path as well. While Cisco states that its new ACI platform would provide these large cloud providers with significant savings, these companies have already embedded SDN solutions into their networks, making displacement by new Cisco products potentially unlikely.
Should Amazon continue to dominate the enterprise cloud infrastructure space, it could be difficult for Cisco to recoup revenue lost by enterprise customers who migrate to Amazon's service. Google and Facebook's selection of SDN solutions currently pose less of a threat to Cisco given their generally consumer-focused cloud offerings. However, it seems more likely that Amazon will gain only a portion of the market, and other cloud providers will capture meaningful share over time. Importantly, a key contender for enterprise cloud market share, Microsoft's Azure Cloud Service, is supporting Cisco's ACI solution. Should Cisco's ACI deliver, Cisco has the opportunity to maintain its current revenue streams by selling its products to Microsoft and other cloud providers as companies migrate to the cloud. To put the cloud threat into perspective, it is estimated that Amazon Web Services, AWS, by far the largest cloud provider, will generate $3 billion to $3.5 billion in sales in 2013 out of $300 billion plus in estimated global data center spending. From a high-level perspective, spending on the cloud is still relatively small, and many companies are likely to continue to maintain their in-house IT departments for many IT networking functions. Further, companies that choose to maintain their in-house IT departments are likely to continue to experience increased network traffic, thereby increasing the demand for Cisco's products. Given Cisco's current cheap valuation, we're prepared to give Cisco the benefit of the doubt that it is able to make inroads with many top cloud providers and maintain a large proportion of its spending with corporate IT departments for the functions they choose to keep in-house. Fifth, the Huawei threat is likely to remain limited.
Independent of the case that software-defined networking will destroy CSCO's margins and overall demand for its products, there is a separate bear case that low-cost emerging market vendors such as Huawei will gradually eat away market share and force gross margins lower. 1Q14's recent significant weakness in emerging markets could give credence to this bear case, though there is likely some truth to CSCO's claim that the emerging markets were very weak due to macro factors and political issues in China, perhaps also due to the fallout from the NSA security breaches. For perspective, Huawei has gained 16% share of the service provider market over time primarily in fast-growing edge routers, and beginning in 2011 the company began making a push into the enterprise, Cisco's largest segment.
As Huawei's cost structure and margins are much lower than Cisco, with GMs in the range of 37 to 40% and operating margins around 10%, well below CSCO's 60% GMs and 27% operating margin. Huawei offers customers a much lower cost solution.
However, political dynamics make it highly unlikely that Huawei will ever meaningfully penetrate North America, which represents 33% of the global service provider segment, 42% of the global enterprise segment, and 25% of the global telecom capex per Credit Suisse and Infonetics. And perhaps more importantly, at least per a recent Credit Suisse survey of IT decision-makers, Huawei is perceived to be far worse than nearly all the other vendors on almost all metrics. Note that Huawei performed very highly on price/performance/reliability in a survey of IT networking professionals, but relatively low on every other factor. IT decision-makers' mixed perceptions of Huawei make it seem unlikely that Huawei is likely to significantly accelerate its market share across networking infrastructure anytime soon. Key risks to buy thesis.
There are two fundamental risks to the strong buy thesis on Cisco.
The first risk is more perceptual, that the market never begins to give Cisco credit for the potential that the bear thesis might not play out. This is the risk of buying stocks with secular overhangs that could take many years to disprove. But if the only risk to holding the stock is perceptual and the fundamentals hold, we should at least be unlikely to lose much on Cisco given the current very low valuation.
The second major risk derives from the potential that CSCO's new products do not deliver a compelling enough value proposition to lead enterprise customers and cloud providers to choose CSCO's products over a software-defined networking solution.
While the initial customer uptake and customer commentary suggests that new products should gain traction, the products are still in relatively early stages and could potentially disappoint. The third major risk derives from the enterprise shift to the cloud.
Should enterprises gradually move their data management to whitebox cloud vendors, Cisco will inevitably lose its networking business from its enterprise customers.
To date, CSCO's data center business, which serves the cloud, has been growing strongly, though the two of the largest public cloud providers, Amazon and Google, have chosen to pursue a whitebox approach to networking. Should the major public cloud providers continue to pursue a whitebox solution based on momentum from their previous investments, and enterprises shift increasingly more data to these providers, Cisco is likely to see gradual ongoing declines in its core enterprise networking business. The views expressed are those of the author and do not necessarily represent the views of any other person. The information herein is obtained from public sources believed to be accurate, reliable, and current as of the date of writing. The author will not undertake to supplement, update, or revise such information at a later date. The author may hold a position in the securities discussed. I do not hold a position of employment, directorship, or consultancy with the issuer. I and or others I advise hold a material investment in the issuer's securities. Write-up 3. Short thesis. Date posted, November 22, 2013. Description. As a longtime Cisco bull, we both favored and followed the company for years, and it saddens us to say that Cisco is now a compelling structural short, or at least reducing one's positions. As the leader in a maturing industry that is now clearly commoditizing, the company will continue to lose share in its key markets, switching and routing, which comprises 60% of revenues. The company is headed into a period where it will see continued anemic growth/declining revenues, and margins will deteriorate. It's hard to maintain 60% plus gross margins as your products commoditize. Ultimately, Cisco will trade in line with other large-cap technology hardware peers, i.e. HPQ, Dell pre-buyout, at 4.5x EBITDA. Importantly, consensus assumes CSCO's recent woes will be temporary and expect earnings to be flat next year, despite declining revenues, and a miraculous rebound in 2015, when presumably emerging markets recover. We believe that Cisco is in the early innings of a long earnings decline, as competitive forces rise and the company's competitive position erodes. We expect shares to trade less than $15 per share, versus $21.50 per share today, within the near term. Since Cisco is a well-covered company, written up previously on VIC, we will not discuss in detail its business model, or the networking equipment industry. In fact, research coverage is very good for Cisco, particularly with the presentation of pro forma historical financials. Rather, we will briefly focus on some of the key challenges Cisco is facing, and why we think the company's earnings should decline in the future. Specifically, based on our conversations and research to date, we believe that switching, low and high-end, and edge routing are particularly challenged as CSCO's competition increases and as networking architectures shift to software-defined networking, SDN, over the next several years, which will disrupt the Cisco installed base/ecosystem and commoditize networking equipment. For years, the mantra "no one gets fired for buying an IBM" was adequate to describe CSCO's competitive advantages as the leader in networking equipment, technological innovation and R&D spend, an installed base and ecosystem of administrators trained and accustomed to Cisco standards, and reputation within IT purchasers as the safe choice with the lowest total cost of ownership. For many years, all of this was very true, particularly since network architectures naturally favored one standard/preferred vendor, compatibility issues, training of engineers, repeated certification standards, etc., which Cisco monetized exceptionally well with premium pricing and high-margin services contracts. That one vendor was Cisco, who had little competition and captured historical market shares of 60-70% plus in the switching and routing markets. In fact, a few years ago, this well-known barrier to entry that allowed us to easily dismiss the emerging threats in enterprise switching and edge routing when they first appeared. At the time, it was unclear how new entrants, HP, Huawei, ALU, etc., in the switch/edge routing markets would impact Cisco. Cisco was introducing new products, reorganizing the company, and SDN was in its infancy. The strong secular tailwinds and the Cisco Gold Standard made for a compelling investment when Cisco was trading $15/share in 2011. However, numerous conversations with tech executives and IT administrators today give us a different perception. By the way, I don't know any IT professionals today would say they wouldn't get fired for purchasing an IBM server, except maybe those that retired 10 years ago. We believe CSCO's moat in these two key products, 50% of product revenues, 60% of total revenues including services, is deteriorating, market share has already fallen 10%, and that it will be hard for the company to retain the high margins and near monopoly position it's historically exhibited. We believe we are seeing evidence of this in the company's recent financial performance and the revised guidance. Cisco has traditionally been a switch and routing company which comprises 60% of the company's revenues, estimated including services revenues. The switching industry is a mature industry that has grown slowly in the past several years. The switch market can be bifurcated into low-end switching, mostly used by small and mid-sized businesses, and higher-end switching, for large enterprise and data centers. Cisco has been overserving the low end for years, and now most of these enterprises frankly don't need premium switching products. Diminished returns from technology, i.e. Moore's Law, has moved faster than most small enterprises need, and many are beginning to outsource much of their IT needs. HP entered the switching market and has been successful as a low-priced entrant. They have continued to gain share, and the battle for these small/mid-sized customers has only gotten more competitive as the years have passed and as acceptance of HP grows. According to many IT professionals, HP, which has existing relationships with many businesses, i.e. servers, offers much of the same assurances on product warranty/reliability/quality and the support staff that Cisco does. In addition, HP has now been in the market for several years and is establishing itself as a viable alternative with a track record, at discounted prices, usually bundled with server sales. Hence, Cisco is facing real competition at the low end of the switch market. A similar story can be told in edge routing versus core routing. In the routing market, demand will continue to be driven by rising IP traffic, and core routers will likely be dominated by Cisco for a while. Core routing is the least price sensitive, and requires high levels of sophistication and coding that caters to CSCO's strengths and customer services. However, at the edge, lower capacity, less differentiated routers, Cisco is facing significant challenges as ALU/JNPR/Huawei in emerging markets continues to gain significant share. Some of this is because the carriers simply wanted more vendors and didn't want to be reliant on Cisco. Some of this is because competitors has offered as effective products or compete well in certain niches, ALU for fiber optic and mobile, and some is simply that carriers' purchase decisions at the edge simply no longer feel the need to pay the premium for the Cisco products. At the higher end of the switching market, which is primarily used by data centers and large enterprises that have large networks and significant data demands, Cisco has historically been dominant as these customers in this part of the market are particularly focused on reliability and compatibility with existing data center infrastructure. At this end, vendor switching is especially difficult and HP hasn't made significant inroads. However, SDN is rapidly growing in acceptance at data centers, and in the next few years, we expect more data center administrators to adopting SDN. Based on our diligence, SDN is going to gain acceptance and dramatically change the value of having one preferred vendor. Basically, SDN adds an open technology software layer above the equipment to shuffle IP traffic. No longer is the traffic routing decisions made at the switch/router level, but at a meta layer above the equipment. The result is that the equipment is little more than a commoditized box and equipment vendor decisions will be interchangeable. We believe this is a real threat to Cisco, and all equipment manufacturers, as equipment, even at the high end of switching, essentially becomes a commodity. Though SDN is still in the early stages, most administrators we've spoken to admit Cisco compatibility will be far less relevant in the future. To compete, Cisco will have to be more of a software vendor, which they aren't right now, and we don't think will retain 60% plus gross margins on their equipment. We view much of the recent weakness, -4% YoY product sales / guidance, -8 to 12% YoY, reported by the company is an early warning sign of things to come. The last time revenue declined like this was in the credit crisis. The macro environment is not strong, but it would be hard to assume all of this is macro-related. And this is from a company which has historically generated high single-digit / mid-teen revenue growth in a sector that should be growing rapidly. We think the pause in demand and particular weakness in emerging markets is a sign of the increased competition and price sensitivity to Cisco products. In addition, Cisco right now is going through product introductions in switching and routing that we understand to have been bumpy, and that Cisco currently has a pretty weak backlog. We recognize that Cisco appears cheap on an absolute basis, and on current earnings, it's trading at 5.3x 2013 EBITDA, or 10.7x PE, 6.3x PEX cash, 7.8x PEX cash and tax affected, depending on how you view the excess cash. However, we think CSCO's revenue and earnings will decline and investors will re-rate the security. Consensus, for some reason, thinks earnings will be flat next year despite declining revenue, and that both revenue and earnings rebound in 2015. We anticipate EBITDA down -13% to $13.8 billion, 6.0x EBITDA next year, and EPS of $1.76, 12.2x PE, 7.1x PEX cash, 8.9x PEX cash tax affected. We do not see how earnings rebound thereafter. Remember, margins for Cisco are 60% plus, so it will be very hard for Cisco to find enough cost cuts to continuously offset share losses in switching and routing. Since we view earnings for Cisco in decline, we think the company should be valued like the other mature large-cap technology hardware names and trade in line with HP, Intel and Dell, pre-acquisition, at 4.5x EBITDA. Based on our estimates, we think this implies a stock price below $15 share within the next several years. We recognize we would rather short a high multiple business in decline, but we feel that there are enough headwinds to CSCO's future earnings that in this case it is worth consideration, or at least reducing one's position. Risks: increased dividend/share repurchase. Cisco still generates significant cash and has a large excess cash balance. However, only $6 billion of the company's $48 billion is domestic. SDN adoption takes a more modest pace. Cisco can temporarily offset revenue losses with cost savings. Share losses in switches and routing offset temporarily by growth other products, wireless as data center, etc. However, these are typically lower margin products and Cisco has competition here too. Aruba is gaining share in wireless, etc. Strong management team, i.e. Chambers. Successful new product launches. I do not hold a position of employment, directorship, or consultancy with the issuer. Neither I nor others I advise hold a material investment in the issuer's securities. Catalyst: continued share losses in switching and routing segments lead to declining revenue through 2014. Cost savings and other product growth does not offset loss of high margin sales, earnings decline. Deteriorating macro environment. Washington gridlock, which leads to weak government sales. Continued weak execution of new product launches. Revised management guidance. Write-up 4. Long thesis. Date posted, June 26, 2012. Description.
Cisco is a great company. It is dominant in a large and growing market, albeit a mature one. It sports very high ROIC, greater than 100% little book definition, and 40% plus including intangibles, and cash flow conversion, greater than 100% net income. It has a rock-solid balance sheet. And in my opinion, it is significantly undervalued, 6.6x EBIT, 5.2x EBITDA, 5.7x EBITDA capex, LTM metric. Thesis. Plus cheap on an absolute and relative basis. Plus substantial scale and scope advantages. Plus leader in a market with net favorable secular growth trends. Plus no imminent threat to its market dominance. Plus top-notch management team, whose interest is well aligned with that of shareholders. Plus rock-solid balance sheet, $32 billion net cash. Plus strong cash flow generation, majority of which goes to share repurchases and dividends. Plus continued share repurchases to meaningfully contract share count in light of a rapidly diminishing stock of options outstanding. Leaders moat. Cisco is the 800-pound gorilla in the switching and routing market. As such, it enjoys significant economies of scale and scope. In my view, the most significant is the amount of resources it can afford to channel every year into R&D. This, and its acquisition capabilities, is what enables Cisco to stay at the leading edge of technology. Importantly, its R&D budget is a multiple of all of its competitors combined. R&D expenditures, most recent fiscal year. Cisco $5.8 billion. JNPR $1.0 billion. HPQ $0.7-0.8 estimate based on rev, op margin, and 3Com historical. BRCD $0.35 billion. Its installed base, $200 billion, 50M devices, 6M annual customer interactions, and partner/distributor ecosystem is unrivaled. More IT people are familiar with Cisco, standard setting, you won't be fired for buying Cisco, etc. Services are not only a fast-growing and high-margin recurring revenue stream but also an avenue to further its competitive position. Strong competitive position. Cisco has 70% plus market share. HPQ and JNPR are relatively distant number 2 and number 3 respectively. Further down the food chain, you see BRCD and other niche players. In Gartner's Magic Quadrant matrix, Enterprise LAN, Cisco is clearly the leader. The leader in this matrix is the most visionary with the strongest execution capabilities, and not necessarily the largest player. HPQ is the only other company in the leaders quadrant. Tellingly, the whole matrix is pretty empty. It seems to me that a mostly empty matrix combined with HPQ as your major competitor is a relatively benign situation. Despite recent hiccups, Cisco has not really ceded market share. If you compare the growth rate over the last few years of the four major players, it is hard to argue that Cisco has lost market share. The service provider, e.g. telecom, segment's competition includes Huawei and ZTE. These two Chinese companies are relatively new entrants. Cisco recognizes them as aggressive price competitors in some markets. In the long term, they could become a not insignificant threat. Despite meaningful competitive pressure, a relatively recent product transition, corporate restructuring, and not insignificant exposure to Europe, FY12 will be a record year for Cisco. Strong corporate governance. Plus the CEO, John Chambers, is the single largest individual shareholder. Plus for all practical purposes, the company stopped granting options 4 years ago. Instead, most of management's compensation is in the form of restricted stock, greater than 90% FY11. For example, the CEO's salary is $375,000. The remainder of his compensation is in the form of restricted stock, $12.5 million FY11. This, obviously, is a much better way to align management's interest with that of shareholders. Plus it initiated a dividend in FY11 and increased it in FY12. Plus it has repurchased large amounts of stock. A mountain of options is mostly in the rearview mirror. One common criticism of Cisco is that its share count has not decreased in proportion to its massive share repurchase program. It is a fact that dilution has mitigated to a significant extent the benefits of share repurchases. However, this is mostly in the past. Over the last few years, the company has had to issue large quantities of stock to satisfy the mountain of options that resulted from the late 1990s early 2000s collective delusion that argued that options/stock-based compensation is not an economic cost. The number of options outstanding peaked in 2006, 23% of diluted share count. With the elimination of option grants and a lower share price, it has naturally seen a steeper decline since July 2008. As of April 2012, options outstanding are less than 10% of diluted share count. Looking forward, about half of the options outstanding as of July 2011 expire within the next year or so, and the last batch of options expires in 2016. Notably, all of top management's options outstanding have exercise prices at least 10% higher than the current stock price, and the vast majority above $20. Clearly, a higher stock price is in the interest of senior management. And for all practical purposes, management won't see a dime before a long position at the current price sees a nice ROI. A layman's view of secular trends. Perhaps the two most important trends in the switching and routing market are exponential growth of data traffic and cloud computing. Obviously, data traffic growth is a positive. It seems to me that cloud computing is a net positive for market leaders. On one hand, cloud computing adds nodes, data centers, to the network. This is a positive because each new node needs equipment, a meaningful portion of which is high-end equipment. On the other hand, data centers not only purchase and use equipment more efficiently but also reduce the equipment intensity of non-data center nodes. In summary, plus increased volume, plus premium on leading-edge technology, pricing pressure, less favorable mix in aggregate. Why is it trading at these levels? There has been a meaningful adjustment to growth expectations and some gross margin compression. Coming out of the depths of the 2008-2009 financial crisis, management was targeting mid-double-digit plus revenue growth. Recently, the growth rate was lowered to 5 to 7%, for at least for the next couple of years. The European crisis and weakness in the public sector are the main external factors behind this downward adjustment. Aggressive competition primarily and a product transition are the main factors behind lower gross margins. Management expects the competitive environment to remain aggressive. In turn, it has adjusted its business model to 60 to 62% gross margin, compared to the 64% plus of the previous decade. Naturally, the stock has been punished. I don't think Cisco was priced to grow 15% plus prior to the downward adjustment in guidance. Notwithstanding, the result of punishment on top of an undemanding valuation has created the current opportunity. Importantly, the company has mostly completed a restructuring initiative centered on refocusing on its core markets and lowering its expenses. As a result, operating margins have moved upwards and are pretty much of par with those preceding the financial crisis. The same is true for EBITDA-CAPEX margins. A word on relative valuation. In my view, Cisco is clearly undervalued in absolute terms. Its FCF yield is 17%, $10 billion cash from ops CAPEX $60 BTEV. It is also inexpensive on relative terms. It trades at a multiple of EBITDA-CAPEX that is a fraction of JNPR or BRCD. Compared to other large tech companies, it is trading at a similar level to HPQ on an EBITDA-CAPEX basis, and at a huge discount on FCF yield. This is clearly myopic. The quality of the company, its competitive position, the competitive pressures, etc., are completely different. I would argue that a better comp would be Intel, although it is not necessarily cheap and faces much more significant competitive threats. It seems to me that taking it all into consideration, fair value in this market is somewhere around $25. This would still be below 10x EBITDA-CAPEX and FCF/TEV 10%. In terms of macro downside, even if the euro went to $1, I don't see how the cash generation power of this company would warrant a price below $20. Additional risks. Key man risk. I think John Chambers is a top-notch CEO. While the record is not stellar, in balance, I think he is in the top 2% or so of CEOs worldwide in terms of bang for the buck. It is hard for me to name another non-founder/owner CEO of a sizable company whose cash compensation is less than $500,000 and the rest is restricted stock. For instance, I have a hard time finding a better CEO among the DJIA components, especially adjusting for amount and structure of compensation. Service provider consolidation is a negative, especially in accounts susceptible to competition from Huawei et al. If one considers significant further service provider consolidation a meaningful risk, then shorting AMT could well serve as a hedge to this risk. Most of the cash pile is outside the US and subject to tax if repatriated, and issue common among large tech companies. Catalyst. Consistent execution in the form of earnings and guidance, August 15, Q4 and FY12 earnings. Write-up 5. Long thesis. Date posted, March 10, 2011. Description. Cisco CSCO is the #1 networking equipment company with high market share in its key businesses, high margins, mid-60s gross margin, mid-20s operating margin, and growth. Revenue and EBIT have grown 11% and 12%, respectively, since 2003. About half the company's revenues are outside of North America, providing investors with significant geographic and currency diversification. Street EPS estimates for the year ended July 31, 11 and July 31, 12 are $1.60 and 1.76 respectively. The company has $4.47 in net cash per share. At the current $18 stock price, netting out an estimated value of $3.65 for the excess $4.47 per share in cash, Cisco is trading at 9x 2011 Street EPS estimates. If we adjust the Street estimates for stock option expense and add back non-cash amortization expenses, the shares are trading at about 10x 2011 EPS. In comparison, the S&P 500 currently trades for over 15x 2011 EPS. The company is facing macroeconomic headwinds and increasing competitive pressures which are likely to impact margins and growth. However, given the company's long history of profitable growth, the diversity of the business in terms of product and geography, and the company's high margins/market share in a growing industry, the valuation today is attractive. For our target price, we apply a 14x multiple to the $1.60 of 2011 earnings and add back $3.65 of cash. Our target is $26, up over 40% from today. At today's price, we view our downside potential at around $15, for an attractive upside/downside ratio. The company has repurchased $65 of stock in past decade. Even after adjusting for an $11 billion of cash stock expense due to issued shares over this period of time, the amount is substantial. Last November, they authorized an additional $10 billion for buybacks. The company places buybacks front and center in its press releases, which is a good sign in our view. From the most recent earnings release, during the second quarter of fiscal 2011, Cisco repurchased 89 million shares of common stock under the stock repurchase program at an average price of $20.15 per share for an aggregate purchase price of $1.8 billion. As of January 29, 2011, Cisco had repurchased and retired 3.3 billion shares of Cisco common stock at an average price of $20.81 per share for an aggregate purchase price of approximately $69.3 billion since the inception of the stock repurchase program. On November 18, 2010, Cisco's board of directors authorized up to $10 billion in additional repurchases of its common stock under the stock repurchase program, increasing the authorized amount of aggregate stock repurchases to $82 billion. The remaining authorized amount for stock repurchases under this program, including this additional authorization, is approximately $12.7 billion with no termination date. The company is planning a new dividend. While they have not had one in the past, they are planning to initiate a 1 to 2% dividend yield in 2011. This may be a mild positive for the company. There is abundant research on the company which we suggest you review. We provide some of our notes below, but would welcome any comments or questions as this is one of the prime advantages of VIC. Notes. General notes. Notes on cash: $37 billion of $40 billion in cash is outside the U.S. The company, along with others, is trying to get the US government to allow for the repatriation of cash at a low tax rate. The US allowed repatriation at 5.25% tax rate in 2004 to help stimulate the US economy and the US dollar. There's a good chance this will happen again. To estimate fair value of the cash, we take 60% chance that it is taxed at 10% and 40% chance it is taxed at 35%, for an estimated fair value of about $3.65. Well-known investors such as Passport Capital, First Eagle Advisors, Appaloosa, Pennant all hold positions, and this is the largest addition to ESL, Eddie Lampert's fund, in the most recent quarter. Readers of this website will also appreciate the fact that Cisco is one of the cheapest large-cap magic formula stocks. It's interesting to think that when VIC was started in 1999, Cisco had a $200 billion market cap, little cash, sales of 12B, EBIT of 3.5B. Back then it earned 40-50C per share and traded up from the $20s in 1998 to $80 at the peak in March 1999. 10 years later, sales are up to $42 billion, the company has $25 billion in net cash, EBIT is up to $9 billion, and the market cap is half of what it was 10 years ago. Business quality, margins, market share, growth. High stable gross/operating margins. Gross margins, 60 to 70% the past decade, currently down to 62 to 63% from 65% last year. Operating margins, 25 to 31% since 2003, currently 25%, down from 29% last year. High market share/margins in core switching/router businesses. Ethernet switch, currently 72% of $18B market equals 13B, 32% of 2010 revenues. Market share grew from 63% in 2001 to 75% in 2007, has declined to 72% since. Service provider router, currently 48% of $7.6 billion market equals 3.7B, 9.7% of 2010 revenue. Was 72% of $4.5 billion market in 2001, flat share last 2 years but otherwise declined since 2001. Enterprise router, currently 83% of $3 billion market equals 2.5B, 6.3% of 2010 revenue. Was 92% of $4.6 billion market in 2001, but flat past few years. Switching/routing, 47% of 2010 revs plus the majority of the 7.6B, 20% of service revenues. Regarding margins, switching thought to be 75% and routers 65 to 75% gross margins. High historical growth in revenue and earnings. Revenue and EBIT have compounded by 11% and 12%, respectively, since 2003, 8% and 9% compounded since 2000. $20 billion plus in acquisitions has driven significant part of growth. EPS has grown 15% compounded since 2003. Growing recurring service revenues, 21% of revenues, support contracts generally over life of product. 15% growth past decade and increasing growth/gross margins, 67% currently. Company growth estimates. 12 to 17% long-term revenue growth targets, this proved too optimistic and was reduced to 9 to 12%, low end, for 2011 in latest quarterly release. Significant growth opportunities were noted. Some of the growth opportunities include: market expected growth, 9 to 10%, switching, mid-single digits, routing, high single digits, services, low double digits, advanced technologies/other, low teens, third-party estimates. Gain in share of wallet, 3 to 4% due to virtualization/cloud/collaboration/video. Emerging countries, 0 to 1% and market adjacencies, 0 to 2%. Other notes on growth drivers. Video is expected to increase IP traffic by 4x from 2009 to 2014. Video will make up 90% of traffic by 2013. 400% increase in web-enabled devices. Virtualization/cloud, 25% of network IT growth driven by virtualization through 2014. $50 billion addressable market over next 3 to 5 years, 37B in FY10. Collaboration, $38 billion market opportunity in 2 years, 100
108% CAGR from 2009 to 2014. Before hitting recent speed bumps the past 2 quarters, John Chambers said he was the most optimistic he's ever been due to the many opportunities for growth. Bear case. The bear case is that the weakness in the past 2 quarters is a sign of permanent decline in margins/growth rate. To put this into context, we have the following thoughts. What happened in Q1 lowered guidance for FY 2011 from 12 to 17% rev growth to 9 to 12%, as Q2 will be weak due to air pocket in public sector and service provider, cable/set-top boxes. Expect weakness in cable set-top boxes in US and Canada to continue for several quarters. What happened in Q2, guidance for FY 2011 will be at low end of 9 to 12% growth, wouldn't comment on long-term growth rates. Product gross margins were down 290 bps quarter-on-quarter in the past quarter, with switching contributing 100 bps of this, 7% drop in switching revenue. Guided to continued weakness in Q3/Q4, 62 to 63% gross margins, down from 65% plus. Weak public sector, expect a rapid decrease in discretionary IT spending in the majority of governments. The decline in the margins is due to increasing competition from HP/Juniper/Huawei/ etc., which will continue to erode the business. Some analysts are arguing that there is a paradigm shift underway to having best-of-breed devices in network instead of end-to-end architectural solution. HP has gained some share in switching, but it is primarily in low-end low-margin solutions for colleges and small businesses and doesn't really compete with Cisco's high-end high-margin switches and routers. Juniper has some high-end products, but lacks an end-to-end solution/architecture. Huawei has made some inroads, particularly in service provider routers, and will likely continue to be a threat as a price-focused competitor, but primarily plays in the low-end market. Cisco grew Asia-Pacific by 27% year-over-year, which is Huawei's strongest area. Public sector weakness. Public sector spending has always been unpredictable in the short term, can have rapid decreases in discretionary IT spending by govs/municipalities when there is economic weakness. However, Cisco is not losing market share and generally experiences a catch-up period following pullback, as the networking equipment is necessary. Router/switch weakness. Cisco is undergoing a number of product transitions to new generation at once, which is causing lower margins during this period. New products have higher price performance, double the performance for same price, and thus lower margin during early life. Cisco HSA never had this many products transitioning at once. Best-of-breed versus end-to-end architecture. Some argue that standardization is driving an adoption of best-of-breed products, resulting in an unbundling effect for Cisco. However, networks are getting more complex and require a full architectural solution. Cisco generally has many-year relationships with its customers and works closely with them in determining their product/architectural roadmaps, incorporating requested features into designs. Proof of this is the rapid growth in service revenues, now 21% of revenues. In recent years, this wouldn't be the case if networking devices were becoming plug-and-play. Our overall view of the bear case is that it is legitimate, but currently reflected in the stock price. Catalyst. Continued stock buybacks and dividends. Gross margin decline stabilizes and reverses as router/switch margins grow following ramp-up of new product lines. US allows repatriation of offshore at a low tax rate, would likely be precursor to large share buyback and dividend increase. Increased public sector spending following next couple quarters of weakness.